Hi everyone, I'm Dana Samuelson. I'm president of American Gold Exchange in Austin, Texas. I'm a physical precious metals and classic US gold and European coin dealer. I've been in the business 35 years. I founded American Gold Exchange in 1998. We've done over $1 billion in flawless business, and I've watched the gold market continuously, silver, platinum, and palladium also, for the last 20 years. And today, in late October of 2015, we're here to talk about the influencing factors in the gold market. Also, we'll talk about silver, platinum, and palladium a little bit. So let's take a look at the screen, please. And we're going to talk about the US dollar. The most influencing factor in the gold market for the last 18 months to 24 months has been the relative strength of the US economy versus other economies in the world as measured by US GDP quarterly and by proxy US jobs reports monthly. That's how we tell how strong or weak the US economy is. Now, this is a chart of the US dollar index, which measures the dollar against a basket of currencies. And it also has plotted on it in the quarters of first, second, third, and fourth by time frame, US GDP from last year when the US economy got real strong while the Japanese economy and the European economy was weak. So our strength, which started in the second quarter, and we had, well, first of all, we had a horrible first quarter, minus 0.9% GDP. The previous 5 years have all been horrible during the first quarter, and that's going to come into play in a little bit. But during the second and third quarter of last year in particular, we had very strong US economy, especially relative to Asia and Japan in particular. And this created a flood of money worldwide coming into the US for safety, where their currencies were weakening. Safety was here. So if your money was in the euro, you were losing ground against the dollar. If you put your money in the dollar, you were gaining ground. Same thing with the Japanese yen. And you can see how the dollar index took off like a rocket. And this inversely, as Jim Rickards said this morning, this inversely pressures the gold market because gold is priced internationally in dollars, and as one goes up, the other goes down, and vice versa. So we had a rip-snorting second and third quarter of last year. These arrows point to the time frame when, approximately when the GDP was announced, because there's a 2 or 3 week lag between the end of the quarter and the announcement of the GDP. So this put the dollar up to a 12-year high early this year. Since then, we've seen a downtrend develop as the US has not done as well this year as it did last year. And also, we've had some balance where the European economy was coming up a little bit earlier this year. But we've had some changes since July, which are material for us. And the primary changes, China has weakened, as you all know. So we've got the US dollar now in a downtrend with support here a little under 95 and a little under 93. And you can see how GDP this year has been weaker than it was last year, fundamentally weaker. This was estimated on the Atlanta GDP Fed number as of Monday, and they came out since then and said GDP is actually 1.5, so a little bit better. So this is how strong the dollar has been. We think the dollar has probably peaked, which is why it's possible that precious metals already have hard bottoms in. It's a little too early to tell. But let's take a look at the gold chart. And you can see as the dollar went up during that corresponding time, gold came down. We had major support at 1180, which broke in November of last year, briefly. We went back up to 1300, came back to 1180, broke again to 1148 this time. We set a series of set a series of lower highs, but had a pretty flat bottom, which we broke this summer. This is when the Chinese announced that they only had 1,600 tons of gold instead of much more that people thought they had now. If you watch Jim Rickards this morning, he thinks this is the published figure, but he actually thinks the Chinese hold 4,400 to 5,000 tons of gold. So when the gold price broke, there were also, at this point in time, there were also, at one moment, there were 3 million contracts sold on the futures exchange, which broke the price. Gold broke under 1,100, hit 1084, and we've been trending back up since then. So we're seeing a real strong uptrend with a very good reason for this to be a bottom, which is possibly the dollar has peaked. Now, the U.S. economy is clearly losing steam, as you all know. Jobs last year, monthly, averaged about 225,000 jobs a year. This year, we're averaging a little bit under 200,000. The last two jobs reports in particular were weaker, much weaker, 142, 150. So we're seeing weakness in the U.S. economy, and there's been a balance that's been deflationary pressures outside of the U.S. versus a stronger U.S. economy. And the seesaw has been, can the U.S. pull itself and help lift the rest of the world's economies up, or are we going to get dragged back down? We think that we're being slowly pulled back down by deflationary pressure. So gold right now is perhaps at a major turning point. We ran all the way up to 1185 2 days ago when the Fed put on the table in their latest communique with no interest rate rise that they could actually raise rates in December. Specifically mentioned that, which has pressured gold back down to 1140 today, which is right at the support level we identified months ago as major support here, which has been broken in this extremely weak period. Now, we're also in a seasonal demand time where gold buying worldwide is strong, which should help buoy the price. So gold at 1140 is pretty critical here. If we break down below this, we're still in an uptrend technically, but if we go below 1130, we could see newer lows. We think the trend will be higher as the dollar weakens as we go forward. So it's very possible that we've got a pretty good bottom in gold here at 1084. And we've got to get over 1180 and hold it, get over primarily psychological resistance at 1200, but more fundamentally technical resistance at 1225 to signal a real breakout. Let's look at silver, because silver is a little bit more telling. There's something interesting in silver. Here's the silver chart in the last 2 years. It's similar to gold, a little bit more choppy, a little bit more violent. What we've got here, though, is the most interesting part. Silver held support at 1550 for most of the last 2 years, and then it broke this summer, the same time as gold did. Now, when silver broke support at 1550 and got under 1475 here, the world bought silver to such a degree that every major silver manufacturing entity in the world has been backed up. There hasn't been enough physical silver to supply the demand. By example, for the last 6 years, during the months of June, July, and August, the U.S. Mint has averaged about 3 million silver eagles per month, 9 to 10 million during those 3 months every year. This year, they did about 15 million, 50% more, and they still couldn't keep up with demand. The Canadian Mint faltered, the British Royal Mint faltered, the Australian Mint faltered, the Austrian Mint faltered. We've seen a worldwide physical shortage of silver. I've never seen that in my 35 years in the business. This tells me, and premiums for physical silver went up. They doubled. So despite the price of silver being in the under $15, people were paying $18, $19, $20 an ounce to physically have it. This tells me that the world doesn't want silver at under $14.50, and they want it bad. So I think this really is a point where we have probably a rock-hard bottom in silver, because if it gets low, we've got a demonstrated buying pattern, and it's not isolated. So with silver so strong physically, this tells me that the paper COMEX price, where most of silver is traded, is not correct. The physical price may prove to dominate the market again, which is something we haven't seen since the 1980s, when I first got in the business, when the physical price determined the futures price and not the other way around, which has been the case for most of my professional career. Question?
You said a shortage of silver. Is it really a shortage of silver or a bottleneck somewhere in the chain from mines to ingots to blanks to production capacity of the business?
So the question is there really a shortage of silver or just a bottleneck in the availability of minting? It's definitely a bottleneck, but I think it's fundamentally a bit more than that, because even the 100-ounce bar manufacturers are behind too. And it's much easier to make 100-ounce bar than it is to make 101-ounce blanks, 100 times the time and effort. So we haven't seen 1,000-ounce bars get that problematic, but I heard from a colleague here at the show that there was a large 1,000-ounce bar order that normally takes you 5 minutes to fill, took him 4 days, and 5 vendors to do it. Yes, sir.
So Eagles and Maples, I've seen the premiums drop significantly the last 2-3 weeks.
The last, yes, 2 weeks in particular.
2 weeks across the board. So what's going on there?
So the question is, now we're seeing the premiums for fabricated silver products come back more towards a natural range. Well, we've had a 3-month, 4-month delay, and the premiums got very high. Now, we've never seen this situation, so demand has slowed down, the mints are able to catch back up, so we're getting back into a more equilibrium phase. But this is just the first shot. Now, what happens if it gets cheap again? What happens if something external happens and there's a run to the metals like there was in 2009? Okay, this tells me that this is a much more sensitive situation than we've ever seen before. It is perhaps the canary in the coal mine going off. So let's look at platinum and palladium. This is a downward trend for platinum, which is now trading at a discount to gold of over $100. We see this occasionally, but not very often. In my career, over the last 35 years, we've seen 3 or 4 periods of time, which are usually relatively short-lived, 3 months to 6 months, where we get a discount of platinum to gold. At this point in time, platinum was at a discount of $225. That's now narrowed down to about $150. But platinum's made a serious rebound too, and that's good. So hopefully we may have a hard bottom here. But like silver, we also want to look at palladium. Palladium has been one of the strongest metals over the last 3 or 4 years, and it got real weak this year. It broke support at 590 and went all the way to 531. Since then, it's rebounded to over 700. This is a very, very strong rebound. So like silver, the world loved palladium under 600 and especially under 650. So we think we've got a rock-hard bottom in silver. We've got a strong bottom in palladium. We may have a bottom in platinum, and we may have a bottom in gold. We're a little too early to tell time-wise, but if the U.S. economy continues to weaken and the dollar continues to weaken, gold will only go up. And in the environment that we're in, where is the Fed going to raise rates or not? If they do raise rates, they're going to raise them a 1/4 point, and then they may not raise them again for months. Every previous cycle where the Fed has raised rates, they've raised them a 1/4 point every meeting. So this is going to be a much more gentle cycle, and with so much debt in the world, as Jim Rickard said, when you have debt and deflation, that's a recipe for a currency default, a currency crisis. And I've never seen a situation in the world where we're more vulnerable to this kind of a situation. If they raise rates, we crush emerging market economies who have $3 trillion in debt. 3-4 years ago, Brazil was averaging 6% GDP. Now they've got 1% GDP. They're oil dependent, and they've got huge debt. And it's in their currency, and they have to pay it back in dollars because they've borrowed it in dollars, rather. So paying it back in their currency is much more expensive. So the Fed's caught between a rock and a hard place. We agree. We think it'll be very difficult for the Fed to raise rates, which is bad for the dollar and good for gold. And that's why we think we may have found a real turning point, and this may prove to be the bottom. So let's see. We have just another couple minutes. Are there any questions? Any other questions? So that's it. So watch the value of the dollar. Watch the monthly U.S. jobs reports. We're going to get another one at the end of next week. That's the fundamental monthly signal that you're going to get as to how strong or weak the U.S. economy is. And look at U.S. GDP. And remember, first quarter GDP for the last 5-6 years has been horrible. And we're going to the first quarter again is the next one. So we think that we're in a phase where we may have a bottoming phase here for metals. And this correction that we've been going under for the last 3 years may prove to be a turning point and going higher again. So we're not continuing a bear market. We've been in a major correction in a major bull market. Time will tell. So thank you for your time. Appreciate it. And we'll look forward to seeing you on the exhibit hall floor.